If you were born before 1961, you are inside the exact age window that new 2026 Social Security rules were written to affect. Some people in this window will see their monthly check increase. Others will see something taken away, quietly, automatically, without a single phone call. And if you do not know which category you are in before your next payment arrives, the damage may already be done. Let that settle for a moment. Not as a possibility, not as a worst case scenario, as a reality that is already being processed inside Social Security Administration computers right now in 2026 against your specific birth year, your specific earnings record, and your specific filing decisions. The Social Security Administration does not send warning letters when a rule change affects your payment. They send a revised deposit, and if you are not watching, if you do not know what to look for, you may accept a lower number as correct simply because it arrived in your bank account with the SSA's name attached to it. The average affected retiree in this birth cohort stands to either gain or lose between $2,400 and $6,800 per year, depending on whether they understand what is changing and take the right steps before the deadline. We are going to walk through 7 critical Social Security rules that apply specifically or disproportionately to people born before 1961. Some of these rules are new in 2026. Some have been on the books for years, but are being enforced or calculated differently starting this year. All of them can change the number that lands in your account every month. And item number 6, we will get to it around the midpoint of this video, is the one that affects the most people and that almost nobody in this age group has been told about. It involves a calculation method the SSA uses that can quietly reduce your benefit by hundreds of dollars a month without ever triggering a formal notice. Stay with us until we get there. Here's what you need to understand about the Social Security Administration before we go any further. The SSA administers a program that sends payments to over 70 million Americans. At that scale, the institution does not operate with your individual circumstances in mind. It operates with formulas, with batch calculations, with automated systems that apply rule changes to entire birth year cohorts simultaneously, and then process any disputes months later on the agency's timeline, not yours. Congress passed the Social Security Fairness Act at the end of 2024. The SSA has been implementing its provisions throughout 2025 and into 2026. Separately, the standard benefit formula is being affected by new average wage index adjustments, updated full retirement age calculations, and revised earnings test thresholds, all of which land differently depending on whether you were born before or after specific dates in the late 1950s and early 1960s. The system was not built to protect you, it was built to administer a formula, and when the formula changes, the system changes your payment, whether you were ready or not. Here are 7 rules every person born before 1961 needs to understand, starting with the one that may already be adding money to your check that you have not yet verified. Rule number 1, the Windfall Elimination Provision Repeal, and what it means for your 2026 check. For decades, 2 provisions inside Social Security law have quietly reduced benefits for specific groups of retirees. The Windfall Elimination Provision, known as the WEP, and the Government Pension Offset, known as the GPO. If you worked in a job that did not pay into Social Security, a state or local government job, a school system, certain federal positions, and you also earned Social Security through other work, these 2 provisions could cut your benefit by hundreds of dollars per month. The Social Security Fairness Act, signed into law in January 2025, repealed both the WEP and the GPO fully, permanently. Here's the dollar figure you need to hear. The average WEP reduction that was being applied before repeal was approximately $587 per month. The average GPO reduction for affected surviving spouses was significantly higher, in some cases exceeding $1,000 per month. These reductions are now gone for qualifying individuals, and the SSA was directed to pay retroactive benefits going back to January 2024 for those who were affected. But here's the first detail most people in this group have missed. The SSA has been processing these retroactive payments in waves, not all at once. Some affected beneficiaries received their back payments in early 2025. Others are still waiting. And a subset, particularly those whose records show mixed employment histories have had their cases flagged for manual review, which can delay payment by 6 months or more. A retired school administrator in Ohio, 67 years old, 28 years in the state pension system, and 14 years of private sector Social Security earnings, had been receiving a WEP reduced benefit of $540 per month instead of the $1,127 she was entitled to under her full earnings record. After the repeal took effect and her case cleared SSA review, her monthly payment increased to $1,127, and she received a retroactive lump sum payment of over $13,000 covering the prior months. In California, Texas, and Illinois, states with large public employee pension systems, hundreds of thousands of retirees were affected by the WEP and GPO. Many are still waiting for corrected payments. What to do right now? Log into your My Social Security account at ssa.gov. Review your current benefit amount and compare it against your earnings statement. If you worked in a non-Social Security covered job at any point in your career and your benefit seems lower than your earnings history would suggest, call the SSA directly at 1-800-772-1213 and ask specifically whether a WEP or GPO reduction is or was applied to your record. If the repeal has not yet been reflected in your payment, ask to be escalated to a claims specialist. This is your money. It may already be owed to you. Rule number 2, the full retirement age boundary, and why 1960 is the critical birth year. This rule is deceptively simple, and the consequences of misunderstanding it are permanent. Your full retirement age, the age at which you receive 100% of your Social Security benefit with no reduction, is determined by your birth year. For everyone born in 1959 or earlier, full retirement age is 66 years and some months. For everyone born in 1960 or later, full retirement age is 67. If you were born in 1960, you turn 67 in 2027. But the filing decisions you make in 2026 this year will determine whether you receive a permanently reduced benefit or your full entitlement. Here is the number that makes this consequential. Claiming Social Security at 62, the earliest possible age, results in a permanent reduction of up to 30% of your full benefit. If your full benefit would be $2,200 per month, early claiming could lock you into $1,540 per month, forever, for the rest of your life. But here's the detail that most people born in 1960 specifically are missing right now. Because full retirement age for this birth year is 67, not 66, there is an additional 12 months of waiting required to avoid any reduction. Many people born in 1960 have seen their parents or older siblings claim at 66 with no reduction and assume the same rule applies to them. It does not. A retired warehouse manager in Pennsylvania, born in November 1960, planning to file in 2026 at age 65, had built his entire retirement income plan around a benefit estimate from an SSA statement that was several years old. His financial planner, reviewing the case, identified that his planned filing date would trigger a 20% permanent reduction, approximately $390 per month, less than his full entitlement. Waiting 24 additional months would eliminate that reduction entirely. In states with high cost of living pressures, Florida, New York, Arizona, this distinction between 66 and 67 as full retirement age is causing real financial harm to retirees who did not receive updated guidance. What to do? Pull your most recent Social Security statement from ssa.gov. Confirm the full retirement age listed in your personal record. If you are born in 1958, 1959, or 1960, verify the exact month and year that corresponds to your 100% benefit threshold. Do not file based on memory or on what you observed in someone else's claiming experience. The rules changed. Your birth year determines which version applies to you. We still have 5 more rules ahead. And rule number 6, the one involving the SSA's quiet calculation adjustment, is still coming. Keep watching. Rule number 3, the earnings test threshold, and why returning to work in 2026 may cost you more than you expect. If you are collecting Social Security before your full retirement age and you are also earning income from work, the Social Security Administration applies what is called the Retirement Earnings Test. For every $2 you earn above the annual threshold, the SSA withholds $1 of your Social Security benefit. In 2026, that threshold is $22,320 per year for beneficiaries under full retirement age for the full calendar year. That is $1,860 per month. If you earn above that amount, the SSA begins withholding. Here is the dollar impact. If you are collecting $1,800 per month and you return to part-time work earning $32,000 per year, which is $9,680 above the threshold, the SSA will withhold $4,840 over the course of the year. That is roughly $403 per month in reduced payments across the affected months. But here's the critical nuance. The withheld money is not lost permanently. Once you reach full retirement age, the SSA recalculates your benefit to credit you for the months it withheld payments, which results in a slightly higher monthly benefit going forward. So in the long run, the math may be neutral. But in the short run, in the years before full retirement age, the cash flow reduction is real and can be severe for people living on fixed incomes. And here is the mortality stake embedded in this rule. If you are returning to work because of a health event, a medical bill, a caregiving expense, a change in your living situation, and you do not know this threshold, you may find your Social Security benefit simultaneously reduced during the exact period you need it most. Once you are managing a health crisis or a caregiving role, revisiting your SSA withholding calculation is the last thing on your mind. In Georgia, North Carolina, and Tennessee, states with growing populations of semi-retired seniors taking part-time employment, this rule is generating unexpected payment reductions that beneficiaries often attribute to errors rather than policy. What to do? If you are under full retirement age and considering returning to work, even part-time, calculate your projected annual earnings against the $22,320 threshold before accepting the position. If you expect to exceed the threshold, contact the SSA and ask them to project the withholding impact on your specific benefit amount. You may decide to delay returning to work until after full retirement age, at which point the earnings test no longer applies at all. Rule number 4, the survivor benefit filing window, and why 2026 is a pivotal year for widows and widowers. If your spouse passed away and you have not yet filed for your own Social Security retirement benefit, you may be sitting on a decision that could cost your household between $50,000 and $180,000 in lifetime benefits, depending on which benefit you claim first and when. Here is how this works. As a surviving spouse, you have the option to claim a survivor benefit based on your deceased spouse's earnings record, or your own retirement benefit based on your own earnings record. You do not have to claim both at the same time. In most cases, a strategic approach, claiming the lower benefit first to allow the higher benefit to grow, results in significantly more lifetime income. In 2026, the maximum survivor benefit for a surviving spouse at full retirement age is approximately $3,822 per month. If your own retirement benefit at 70 would exceed that amount, there may be strategic value in claiming the survivor benefit now while allowing your own benefit to grow at 8% per year through delayed retirement credits. Here is the detail that most surviving spouses born before 1961 are missing. The rules for switching between survivor benefits and retirement benefits change under the Social Security Fairness Act implementation guidance. Some strategies that were straightforward before 2025 now require additional coordination with SSA claims specialists to execute correctly. A widow in Arizona, 64 years old, her husband passed at 71 with a strong earnings record, was advised by a well-meaning family member to simply file for everything at once. A Social Security specialized financial planner reviewed her case and identified that by claiming survivor benefits at 60, the minimum survivor benefit age, and allowing her own retirement benefit to grow until 70, she would receive an estimated $214,000 more in lifetime benefits than the file everything now approach. The window to adjust her strategy was still open, barely. In Texas, Florida, and Illinois, SSA field offices have reported increased appointment volumes from surviving spouses revisiting their benefit strategies after learning about the strategic claiming options that exist specifically for their situation. What to do. If you are a surviving spouse and have not yet filed for Social Security, or if you filed but are under full retirement age, schedule an appointment at your local SSA office and ask specifically about the coordination between survivor benefits and your own retirement benefit. Request that the claims specialist model both claiming sequences and provide you with a written benefit estimate for each. The cost is nothing. The potential lifetime impact is substantial, and rule number 6 is still ahead, the one involving the SSA's average wage index adjustment and what it is doing to benefit calculations for people born in the late 1950s specifically. Rule number 6, the average wage index adjustment and the quiet recalculation that may already be reducing your benefit. This is the one. This is the rule that almost nobody in this birth cohort has been told about, and it is operating inside the SSA's systems right now against your earnings record without any notification being sent to you. Here is how it works. When the Social Security Administration calculates your retirement benefit, it does not simply look at how much you earned. It indexes your past earnings to account for wage growth across the economy over your working lifetime. Low-earning years from the 1970s and 1980s are adjusted upward using what is called the average wage index, a multiplier that reflects how much wages have grown since you earned that money. The AWI figure used in your calculation is locked in at age 60. Whatever the average wage index showed in the year you turned 60, that is the indexing factor applied to your historical earnings forever. Here is where it becomes critically important for people born before 1961. The average wage index for 2020, the year that people born in 1960 turned 60, showed an anomalous spike followed by a significant drop due to the pandemic's distortion of wage data. The SSA issued a correction and a hold harmless provision to prevent people born in 1960 from being penalized by that distortion, but the implementation of that correction has not been uniform across all SSA processing centers. Some beneficiaries born in 1960 who filed for benefits in 2022, 2023, or 2024 may have had their benefits calculated using the uncorrected, lower AWI figure. The dollar impact of this miscalculation ranges from $53 to $193 per month in reduced benefits. For a retiree receiving benefits for 20 years, that is between $12,720 and $46,320 in total underpayment. Let that number stand on its own. Up to $46,320 in benefits, you may have already been shorted quietly, automatically, without a single notice from the SSA. A retired machinist in Michigan, born in March 1960, filed for Social Security at 63 in 2023, noticed that his benefit amount seemed lower than the estimate he had received 2 years earlier from his SSA statement. After working with a benefits counselor through his state's SHIP program and the State Health Insurance Assistance Program and requesting a full benefit calculation worksheet from the SSA, the incorrect AWI indexing was identified. He filed a formal reconsideration request. His benefit was corrected upward by $141 per month, and he received a retroactive payment covering the 18 months since his original filing date. In Ohio, Michigan, and Pennsylvania, states with large populations of manufacturing and trades workers born in the late 1950s and 1960s specifically, SHIP counselors have flagged this issue at elevated rates compared to the national average. Here is the deadline warning. If your benefit was calculated incorrectly due to the AWI anomaly, you have a right to request reconsideration. But the SSA's standard reconsideration window is 60 days from the date of your benefit award notice. After that, you move into the appeals process, which can take 12 to 18 months. The sooner you request your full calculation worksheet and review it, the more options you have. What to do? Call the SSA at 1-800-77-21213 and request a formal benefit calculation worksheet, sometimes called a PEBES detail or an itemized benefit computation. Ask the representative to confirm which average wage index year was used in your calculation. If you were born in 1960 and your AWI year shows the uncorrected 2020 figure, ask immediately about the hold harmless correction. If you need help navigating this, contact your state's SHIP program. It is free, it is staffed by trained benefits counselors, and it exists specifically for situations like this one. Rule number 7, the Spousal Benefit Coordination Update, and what 2026 changes mean for couples. If you are married and both you and your spouse have Social Security earnings records, the decisions you make in 2026 about when and how to file are permanently linked to each other in ways that most couples do not fully understand. The spousal benefit allows a lower earning spouse to receive up to 50% of the higher earning spouse's full retirement age benefit. but only if that amount exceeds what the lower earning spouse would receive on their own record. In 2026, the maximum spousal benefit is approximately $1,911 per month. Here is the coordination update that matters in 2026. Under the rules now fully in effect following the Social Security Fairness Act implementation, couples where one spouse was previously subject to the GPO, the government pension offset, may now be eligible for spousal benefits they were entirely barred from before. In some cases, this represents a new income stream that did not exist for these households 12 months ago. A couple in Illinois, both retired educators, the husband with 35 years in the state pension system and the wife with a mixed earnings record, had been told years earlier that the GPO would eliminate any spousal benefit the wife could receive based on her husband's record. Under the GPO repeal, the wife's potential spousal benefit of $890 per month was now fully available. They had not been notified. Their adult daughter found the information online and brought it to them. In states like Illinois, Massachusetts, and Louisiana, where public employee pension systems are large and the GPO historically had the broadest impact, the number of couples now newly eligible for spousal benefits runs into the tens of thousands. What to do? If either you or your spouse worked in a non-Social Security covered job, a state government job, a school system, a municipal position, and you were previously told that spousal benefits were reduced or eliminated due to the GPO, call the SSA today. The rule has changed. The spousal benefit may now be available to you. Ask for a new benefit estimate reflecting the post-repeal calculation. This is not a complicated request. It is a phone call that may result in a new monthly income stream for your household. Here's what you do this week. Step 1. Log into My Social Security at ssa.gov and download your full earnings statement. Verify that every year of employment income appears and is listed correctly. Errors in your earnings record, missing years, incorrect figures, directly reduce your benefit calculation. Dispute any errors by filing Form SSA 7008. Cost, 0. Time, 30 minutes. Step 2. If you were born in 1960, call the SSA and request a full itemized benefit computation worksheet. Ask the representative to confirm which average wage index year was applied. If the 2020 anomaly figure appears uncorrected, ask about the hold harmless adjustment. If you need help interpreting the worksheet, contact your state's SHIP program. Find it at shiphelp.org. Cost free. Time 1 to 2 hours. Step 3. If you worked in any non-Social Security covered position, government, education, certain nonprofits, call the SSA and ask specifically whether a WEP or GPO reduction was ever applied to your record. If it was, ask whether the repeal under the Social Security Fairness Act has been processed for your account. Request a revised benefit estimate. Cost, free, time, 1 phone call. Step 4. If you are a surviving spouse and have not yet claimed benefits, or are under full retirement age and collecting survivor benefits, schedule an in-person appointment at your local SSA field office. Ask the claims specialist to model both claiming sequences: survivor benefits first, own benefit later, and vice versa. Request the projections in writing. Cost, free. Time, 1 to 2 hours. Step 5. Create a Social Security document folder and share the key information with one adult family member. This folder should include your SSA login credentials in a sealed envelope, your most recent benefit award letter, your earnings statement, and a written note identifying which rules from this video apply to your situation. If something happens to you, your family will need to navigate the SSA on your behalf, and they will need this information to do it correctly and quickly. You worked your entire life to earn those Social Security credits, you paid into the system through every paycheck, you planned your retirement around a number the SSA calculated from your lifetime of work. The system is not designed to find its own errors. It is not designed to call you when a rule change affects your payment. It is designed to process, to calculate, to deposit, and to move on. Your spouse should not lose spousal benefits because a government pension offset was never updated in the system. Your children should not watch you accept a reduced benefit because an average wage index anomaly was never corrected in your file. These are not small amounts of money. For many families in this birth cohort, the cumulative impact reaches into the tens of thousands of dollars, money that belongs to you. You are the protector of what you built. You earned this, every dollar of it. Take action this week. Protect what you built. If you know someone born before 1961, a neighbor, a sibling, a friend, who is collecting Social Security and has never heard of the average wage index correction or the WEP repeal, share this video with them today. It may be worth thousands of dollars to them. Next week, we are covering the Medicaid 5-year look-back rule. and the one legal transfer that most estate attorneys say is the single most important move a homeowner over 65 can make before entering a care facility. You will not want to miss it.